Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to cover the basics of 30-year mortgage. We call it Mortgage Review 101. And we're going to go a little bit into in depth as to why the average American loses money with a 30-year mortgage, even if their property value greatly appreciates, right? And just before I get into the topic, I do want to mention that our very first video actually goes into the foundations of how a mortgage works and how to present yourself as an expert to other people, even if you have no real estate experience. So it's called Real Estate Mastery 101, How to Shine Without Experience. And in just speaking from my own personal experience, the easiest way to present yourself as a real estate expert is just to show your fellow American, or even if you're not American, just your fellow citizen of the world, how a 30-year mortgage works. And because your average American or person doesn't even know, they'll be shocked. And that's how you build credibility as an expert in real estate. Okay, so I'm going to make sure that you have a link to that video down below. Now, let's go to the topic. So, why is it that most Americans lose money with a 30-year mortgage, even if their home value greatly appreciates? Now, I'm not saying all, but I am saying most, right? And that's because they don't do basic math, right? So here's the thing. I'm going to show you a cheat sheet of how to translate interest for a mortgage. So we talk about this more detail in the first video that I mentioned, but here in this cheat sheet, this is kind of like my translator. If someone tells me, "Oh, you qualify for a 3% mortgage," I know in the back of my mind that I'm actually paying 50% total interest at the end of the 30-year loan. So it doesn't matter what the loan amount is, just as long as it's a 30-year loan with this interest rate, at the end of the 30 years, I'm going to pay 50% in interest. Same with 5.4, right? So 5.4% interest means I'm paying 100% interest on the loan after 30 years. Same thing with 9.4%, right? So if somebody quotes me 9.4%, that's about 200%. And you know what? I'm paying for 3 houses. So at 9.4, I'm paying for a house for myself and then 2 houses to the bank in interest. Isn't that crazy? So if you don't know where these figures come from, like I said before, just click the first video and the link below, and you'll get a much more detailed explanation. Now, so here we have this cheat sheet. We have an idea of how much a 30-year mortgage is going to cost us. Now, if we actually do a Google search on mortgage interest rates, so today's August 4th, 2023, we can see that in Georgia, the 30-year fixed rate, according to Google, is about high sevens, probably low eights. That's what the interest rate is. But let's just assume that the interest rate is lower. Now, as a society, as an average American, I've been conditioned by the media, by the banking industry, to think that 6% is a pretty good interest rate compared to 7.9, right? So let's just assume, for the sake of an example, that we bought a property at $400,000 at a 6% interest rate, much better than 7.9. And if I can afford the monthly payment, then it's all good. I don't really have to care, because I can afford the monthly payment. The interest rate sure, it's not in the 3s or 2s, but it's relatively low. And so, as long as I can afford the monthly payment, that's all that matters, right? Now, we know just from our cheat sheet, if we take a look at this, 6% is a little bit above 5.4%. So we know just from looking at this, doing a simple comparison, that at a 6% interest rate, I'm paying a little bit more than 100% total interest at the end of the 30-year loan. Now, here's the thing. If you ask the average American, hey, if your home value doubled after 30 years, how excited would you be? They'd be super excited, right? They'd be super excited because, it seems like passive gain appreciation. You just live in a home and pay that mortgage for 30 years, and they're super excited because let's just assume that the property value doubled 30 years later. All right. So think about that. The property value doubled 30 years later. Most people would be ecstatic. This situation is very common in California, where people bought $200,000, $300,000 homes and they doubled or possibly tripled. Now, let's say this is a property in Georgia where you had a property value, the average property value around here in the metro area is 300, 400,000, and you got a 6% interest rate. 30 years later, it's now worth $800,000. The average American will be excited. Now, if you just do basic math, and you can do this by using a Google, just Googling mortgage calculator, putting $400,000 in the loan amount, 6% interest, and then you get the monthly payment. Get the monthly payment, multiply by 12, and then multiply by 30. 12 months in a year, and then 30 years. And then you get the total payment, and you could see how much interest you would pay. Now, let's go here. I'm a little bit lazy. So I got this mortgage calculator from mortgagecalculator.org. They have a free Excel sheet that will give you all the calculations of the mortgage. It's really cool. And even if you don't have the desktop version of Excel, you can get the web version for free, right? So I have the web version for free here. I don't have the desktop version. And as you can see, I've already input the numbers, 400,000, 6% interest rate. And here's the crazy part. I told you this before. 5.4 is 100% interest, right? So you can see about 100%, a little bit more, that the loan amount and the interest rate is almost exactly the same. In fact, the interest is a little bit higher than the loan amount at 5.4. Now, let's say I do 6, right? $463,000 in interest plus $400,000, right? So at the end of 30 years, the total I'm going to pay is $863,000. And it's just basic math, right? Mortgage basics, review 101, $400,000, 6% interest rate, 30 years later, the property appreciates in value to $800,000, and I'm really excited because my property has doubled in value. But wait, if I just do a basic calculation, I didn't gain money. I didn't make money. I lost about $63,000, even with double appreciation on this property. So, what's important? What can we learn from this lesson? Just make sure that you do basic calculations as to the total amount that you're paying. Now, here's the other thing too. Something that I want to throw in there for food for thought is that how long should it take the average American to pay off a 30-year mortgage? Theoretically, it should take 30 years, right? But because of refinancing, because of the statistics that say that the average American moves every 5 to 7 years, you don't really pay off that 30-year loan in 30 years. You every 5 to 7 years, what happens is if whether you refinance or move, you restart a new loan, essentially. So it takes you more than 30 years. And I'll tell you what's a really common scenario is that because of people either pulling out equity, refinancing, selling their home, they almost never pay off their 30-year mortgage in 30 years. So we'll get into more detail about that in another video, but just be aware that this is almost an ideal scenario for your average American. They have a 6% interest rate, $400,000 in property value, and let's say that 30 years later, the property value goes to $800,000, bam, you can see that they lost money even with increasing property values. Even if their property value doubled, right? Doubled, they would still lose with the 6% interest rate. All right. So if you have any comments or questions, please leave them down below in the comment box. And if you're interested in joining our group, please click the Google form link below, and then we'll show you what we can offer you in terms of education, entrepreneurship, business ownership, and real estate educate and other types of education like real estate investment education. All right. Have a great day, and we'll see you next time.